Hi, today we're going to talk about the two basic categories of market participants. So, broadly speaking, they can be divided into two categories, the institutional participant and the retail participant. So, let's take a look at both of them one by one. The retail trader or the retail investor, who are essentially the retail market participant, they are individuals who trade with small amount of money, typically to the tune of few thousands or few lakhs or even few crores. And mostly they are the general public, the self-employed individuals like doctors, lawyers, nurses, etc. Or salaried individuals who are typically working with some organization and they are trading or investing in the market as a secondary source of income, or housewives who are operating from their computers at home, and they could be students who are studying and investing or trading as a part time. So, this particular category of trader investor, they essentially make their buy sell decisions of financial instruments by acquiring information from different news channels, TV news channels, from business newspapers, business magazines, from their peers, brokerage houses, analyst recommendations from their investment advisors, etc. And some of them even study books or take up some courses of technical analysis, fundamental analysis to make their buy sell decisions. Essentially, they don't have the power to move the market or decide the direction of prices. Next, let's take a look at the next category, that is institutional investor or trader. So, who are they? They are typically large institutions who trade or invest with thousands or lakhs of crores of money. They could be banks, hedge funds, insurance companies, mutual funds, pension funds, endowment funds, etc. They are often referred to as the smart money. They literally move the market due to the sheer money power or huge order flow, and hence they have the power to decide the direction of prices. They could be foreign institutions, the FIIs, or domestic institutions, the DIIs. Let's take a look at how some of these large institutions are typically organized and how they typically operate internally. So, here is an example of a mutual fund institution. We all know that the mutual fund institution has a fund manager who is the person responsible for the performance of the fund, what the fund is buying and selling, and what percentage of a particular company is being allocated to the fund, so on and so forth. And these organizations typically employ a lot of qualified people, and some of these people work in their research and valuation department or research and valuation team. They could be highly qualified CFAs, CAs, or research analysts, highly qualified finance people who are tasked to do a lot of research in a particular given company or stock. They acquire information from different annual reports of the company, from different financial sources. They sometimes even talk to companies, their management, to get a fair idea of how the company is performing. And they do all their financial modeling analysis, DCF valuation, and all those things, and come up with a fair value of a given company, a stock. Fair value typical means that what the current price of a stock is in the market, and how cheap or expensive it is vis-a-vis their fair valuation, or the price at which they arrive at. So if they find that a given company is trading cheap, they might be interested in buying that particular company for that particular mutual fund for a good growth in the future. So once they come up with all their analysis, they publish their report internally, and they forward this report to the trading team. And this report typically consists of this company, the stock, which they have researched, the buy fair value price range that they have come up with, and the quantity that the fund needs to acquire of this particular stock for their holdings. So once the trading team is given this particular report or this task to buy a particular stock at a given price band, price range, and of a given quantity, they begin their tasks. Now, these trading members are basically who buy these stocks from the market to their trading terminals or trading desks directly from the exchanges. So, the important part for us to look at is how the trading teams of these institutions, who essentially buy and participate in the market, how do they operate and what challenges they face. So, trading teams are tasked to buy and sell large quantity of a given stock at a given price. They have to buy, sell hundreds or even thousands of crores worth of a stock, which means they have very, very large quantity to fill within a given price range, and because of which they often find it very difficult to get a fill for their orders given the huge quantity they have to acquire. If they buy sell large quantity of a given stock in one single order, this will inevitably cause huge imbalance in the order flow of buyers versus sellers. So if they want to buy and they just punch in large quantity, lakhs of buy orders of a given stock, it will immediately cause prices to shoot up and capture all the sellers available in the path. And the typical problem they will face with this approach is that they will not get a fill of their orders, because with a few quantity only the price will move away from their uh, sort of price band, acquisition price band, uh, a lot. It will move away a lot. So they have to be very careful and very subtle in getting their order fills. Now, to get their order fills, let's say for a buy, they need the opposing party to sell. Now, who could this opposing party be? So they could either be some other institution, or they could be the general retail trader, market participant. Now, the opposing institutions have also huge money power. So fighting them and acquiring from them is a bit difficult for institutions. Whereas getting the necessary fills from the retail traders who can't move the market is pretty easy task for them. So to acquire the given stock from retail traders, they have to resort to a lot of tricks, if I may say, like fake out, stop loss hunting, to get their orders filled from retail traders. So next we will talk about two tricks that these institutions typically resort to get their orders filled for their particular institution. So here you can see the chart on the left. Price rejection happened at candles marked 1 and 2, creating a good resistance line. So if you can see the point marked 1 and 2, the highs of these 2 days, these candles, is where the price rejection happened. And typically retail traders who study charts, they would see this particular price line, this horizontal line, as a very good resistance. Now, uh, there are a particular group of retail traders who are known as breakout traders. What essentially do they do is that they find such points where price got rejected, so-called created a resistance in that price range, and they wait for this price range to be broken. And once the price range is broken, they enter in the direction of the uh, price being broken. They place their stop loss just below the resistance line, and they hope for a good ride in the direction of the price being broken. So you can see that once the resistance was created on day one, on days 1 and 2 marked in the chart, price fell and then again moved up. Then on the day marked 3, price opened with a gap up. And once it opened with a gap up, all the retail traders, they who are breakout traders, they saw that the resistance has been broken, price is ready for an up move. So they typically buy at that open prices, and they place their stop losses, which are stop loss sell orders below the resistance lines, just in case that this breakout doesn't happen properly or it fails. They will exit with a small loss. So once the gap up opens and it invites all these breakout long traders, the institutions, to get their buy orders filled, they push down prices, and they push prices, you can see, below, typically below the resistance line, uh, and they bring it to the area where the sell stop loss orders are placed to fill their buy orders at a cheaper price. And now all the breakout trader stop loss has been so called eaten away, or they have been used to fill the institution's buy orders. And then price shoots up again and then dashes up in the direction. So this is basically one of the tricks that happens often in the market. And this is essentially for the institutions to get their large quantities filled. Here is a second example of how institutions play tricks to get their orders filled. Again, take a look at the chart on the left. If you see at candles marked 1 and 2, again a resistance has been created at the highs of these two candles. At the candle mark 3, price closes above the resistance lines, thereby giving a signal to retail traders that price has broken the resistance and closed above it. And this, like I said, this invites a lot of retail breakout traders that price is now going to go up. It has broken the major resistance and going to go up now. So they buy at that point of the break, and they place their stop loss orders below. Now what happens is that institutions next day push prices little more up on the day marked 4 on the chart, to invite even more breakout traders who are somewhat, sitting on the fence and waiting for more confirmation that this resistance has been taken out. And the price opens, moves up further, and even invites them into the market. And they even buy, again placing the orders below. And now they push prices down below the resistance lines where all their top loss orders were placed. Since they wanted to have a good fill of their orders, so they've got a huge deluge of stop loss orders to fill against, and then the prices is next day is pushed down, and goes down in the direction that the retail traders wanted. So what happened over here? So essentially, the institution wanted to push prices down, so they needed buy orders to fill against their sell orders. And they got that fill from all the breakout buy orders of the retailers. Okay, so the last question to you is that once you have gone through this past slides, is that think, if you were an institutional trader who was tasked with getting large quantities to fill, then what would you do? Like as I said, your easiest opposing traders would obviously be the retail traders who don't have much power to move markets, unlike the other opposing institutions. You would certainly think of ways to get them to sell when you want to buy, right? And what would prompt them to sell? a few points. Negative news in the media when uh, you want to buy and you want to make them sell so that you have their sell orders to fill your buy orders. Or negative signals on indicators like breaking of support lines, resistance line, which I explained in the previous slides. Sometimes even trend line breaks. Sometimes MACD sell signals on indicators and overbought signals on oscillators. And can these signals, these can they be managed? Of course, yes, they can be managed. Think about it once again. And thank you for watching. So if you have been enjoying our channel, our videos, then do subscribe and do hit the like button. That's all for today. Thank you. And I'm going to come up with another exciting video in the next couple of days. Thank you very much.